Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Ella Hoxha, Senior Investment Manager with Global Bonds at Pictet Asset Management, to discuss global rate and credit markets with central banks adjusting policy in an inflationary environment. Ella, it's great to have you with us. Welcome to Trade Talks.
Hi, and thanks for having me.
You got it. And central banks, they're pulling out liquidity and tightening rates at unprecedented levels since the global financial crisis. Something has to give as they respond to inflation, which tends to be a lagging indicator. So what's your outlook with that backdrop?
Right. So we're seeing central banks respond rapidly to what has been a backdrop where we emerged from the pandemic with persistently inflation, the sort of inflation we have not seen since 2010 probably, but at much more elevated levels even. And so in terms of the reaction function of the central banks, it's been rapid in the sense that the Fed only up to 6 months ago was telling us that they would be much slower in terms of how they tighten policy. And in the case of the European Central Bank, it's been even sort of milder in terms of their rhetoric. And so all of a sudden, we have everyone in a concerted effort trying to shift policy to respond to this inflationary backdrop. Now, as you clearly point out, that backdrop is, it's a little bit like driving and looking through your rearview mirror. So we're responding to the inflation numbers that came on the back of sort of a post-vaccination world and recovery post-lockdowns. And so very, very difficult to say that's exactly the sort of setup you're getting this year ahead. And in fact, when you look at break-even markets, they're telling you that probably we're likely to see a stabilization here on the inflation side with this supply chain issues starting to ease off. Difficult to get visibility. Inflation is notoriously hard to predict, and we always know ex post the sort of setup we're looking at. But central banks nonetheless are responding. They're responding because it's hitting real incomes as seen in the wages data. So real incomes are still negative despite the pay rises that we are hearing both anecdotally, but also on broad economic surveys. And therefore, that is not very popular. Politically speaking, it's not very popular. And so this is pointing to central banks who are now under pressure to react, not just from a sort of average citizen point of view, but also politically speaking, under a lot of pressure.
And Ella, how about the UK and the EU? Are their central banks responding in the same way? And how are markets responding to their policy?
Well, in the case of the Bank of England and the European Central Bank, we would say they're probably about 3 to 6 months behind where the Fed was. So it's almost like we're sort of entering that summer autumn period when the Fed shifted, if you want to compare the two exactly like for like. They very different so far. In the case of the Bank of England, they've wanted to toe a very slow transition out of easy policy, quite scared of the sort of economic backdrop on the midst of a pandemic. Whilst in the case of the ECB, they've had less inflation pressure than the other two central banks, so the Fed and the Bank of England. So they had the luxury of being slower. Well, it appears no longer the case. Right. So both central banks are now shifting more in line with markets. And in the case of the ECB, market has had to rapidly reprice. So bringing more in line with the projections in terms of inflation and growth as far as markets are concerned. In the case of the Bank of England, a little shy, we would say, but they're also shifting from what we had priced at least over the course of the last year. So same, but a little bit different, if you like.
Right, right. And then, so how is credit being impacted?
Well, credit had a bit of a wobble back in January when we had the major repricing in tech stocks and Nasdaq and broader equity markets, although to a lesser extent in some markets. Credit, however, has taken it pretty badly recently on this shift from the ECB. Main reason for that being not just the liquidity side, but the fact that the ECB was a buyer of about 60 to 70% of the issue in the European investment credit market. So clearly a larger participant. Therefore, sort of repricing how QE would pan out over the course of this year means that the market has to take on more of this credit supply. And to that front, actually, supply is doubling this year. So the two factors means that credit spreads need to find a repricing at a somewhat higher level. And so we've seen that. Although we're probably about 60% of the way to where those spreads in Europe got to in 2018, so we're not fully repriced for a major tightening cycle, it appears we're still probably halfway through that cycle. So we can see some more weakness here on credit spreads. I would say Europe probably less well placed to the US. There's more appetite certainly from insurance and a lot of other participants that want to lock in higher rates in some of the more quality credit names. But for now, we're viewing credit more on the defensive side. So playing cautiously here, more room to reprice potentially.
Right. And Ella, in the last minute here, how are you positioned with this macro backdrop? There's so many factors that are at play here.
Yes, it's tricky for a global bonds PM. You cannot be fully in cash, right? So we're not paid to sit in cash. So we believe in the value of being fully invested. So you have to manage a portfolio, you have to manage a portfolio, the liquidity factor in mind. So what we've been doing is two risk factors, right? So it's your spread and your duration really that are the dominant factors here. So on the duration side, we've been running lower duration and thinking that the information ratio, so the key to participate actively was more in the curve. So there we've been playing flatteners, so being short of the front and belly of the curve and overweight in the long end of the curve, both in the US and in Europe. And in terms of credit, staying with the higher names and not necessarily going further down the curve in terms of maturity spectrum. So this is how we've been playing defensive. FX, I didn't mention, but it has a very crucial play when we see volatility like this in markets. It tends to be less mean reverting, but it saves you on the tails from a portfolio construction point of view. And so there we've been running lower dollar longs than we typically would have in this phase. But that's again because the backdrop is quite unclear to us from a macro perspective. So there's risks on both ends. But yeah, so we're using FX as a hedging tool on the broad scheme of things here.
All right. We appreciate the insight, Ella. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you.